Hello and welcome to today's webinar regarding capital growth and positive cash flow in residential property for 2013-2014. Prior to commencing this presentation, just some housekeeping concerns. If you have any problems with the technology, please either dial into the support team or enter your concerns directly into the chat box to be helped out. You're able to ask questions throughout the course of this presentation via the chat box, and we'll endeavour to answer these as soon as possible. On the completion of the presentation, you'll be redirected to a survey page where once again you'll be able to ask more detailed questions or arrange for a consultant to call you directly. Whilst this presentation is going on, I'm talking of a general nature. There's no specific financial planning advice being given out today, so please be aware of that. My name is Mike Anderson. I'm one of the directors and owners of Silverhall, a research-based property advisory business that's been around for near on 17 years now. The background of the business and myself spans debt and equity finance, financial planning, property development and sales, and property research. What we've been striving to achieve over that period of time is a comprehensive understanding of what drives the property market, understanding what moves a property from 300,000 to 500,000. It's this understanding of the property market and the characteristics that lead to property growth that allow us to use property as a tool to achieve specific outcomes for our clients. Over the course of the next 45 minutes, I'm going to take you through more about who we are and what we do. What is our product offering, our service offering? I'll then examine the property market. How is the market domestically looking today? Before looking at NRAS, the National Rental Affordability Scheme. A very powerful way to invest in property if applied to the correct asset. Finally, I'll look at opportunities that, for us, we believe will offer substantial capital growth and significant positive cash flow throughout the course of holding that asset. Our business model is that of two halves. We're a research-based advisory business. Research underpins every decision we make, and for our research to be accurate, we have to have a thorough methodology. Our research starts with numbers. It starts with how many houses we have versus how many houses we need. What we're trying to identify is a mismatch between supply and demand, because it's only when we see a mismatch will we see any price movement. We know there's an acute shortage of housing nationally, but we also examine the state supply and demand of property. If we identify a state that has a significant shortage of property, we have to understand within the state where is there more population movement. Why are people moving to different sub-geographic areas? When we identify those areas, we also have to quantify supply. You always have to look at both sides of the balance sheet in order to identify the mismatch in supply and demand. One thing which we've always been able to focus on in terms of leading to future growth has been infrastructure. When we see changing infrastructure, we tend to see changing prices. In the Sydney market, it started with the M2 construction, the M4 upgrade. It was a delivery of the M5 tunnel network, the M7, linking them all together. When these primary infrastructure roads were completed, it led to changes in values across the areas they joined. We also focus on demographics. It's having an awareness of within every particular area, who wants to live in what? Does a client want to live in a 2-bedroom house or a 4-bedroom house? If we get the demographics wrong and we buy a 4-bedroom house where the market says they want to live in apartments, we're going to find it difficult to rent, and we may also find it difficult to on-sell at the end of the day. Our clients are diverse. Of our 12,000 clients, no one's the same. Everyone's got different set of financial fingerprints, and we have to understand that one size doesn't fit all in the property investment circle. We tend to have a variety of entry options, including buying land and building houses, buying properties off the plan. In some cases, we do some small developments for our clients, but these will be suitable to different people in different financial circumstances. What's most different about the Silverhall methodology to most is we focus on an exit point when we're looking at property as opposed to an entry point. We want to understand why the market's going to move such that someone else will buy that asset at a higher price in the future off you. Who's going to be there and why are they going to be there? Most people fail to examine an exit point when they invest in property or invest in shares or invest in oil or gas. They think look, the market historically did okay, so based on trending analysis, the market should move forward in that same manner. It doesn't. It simply doesn't. Property can't be purchased on the basis of what happened last year. So we focus very much on this research methodology to define a clear exit point based on, in many cases, trigger events, and then we source properties in those areas. We don't develop those properties, we don't build those properties. We're simply the conduit, the research conduit between buyers and sellers. So we will source those properties and then we talk to our clients. Our clients have a relationship with us that is ongoing and cyclical. It starts with understanding the goals of the client and then delivering opportunities or options that will suit those goals. And that might include structural advice, but mainly it comes down to asset advice. We assist in the implementation, that is the purchase of the asset. We're not solicitors, we're not conveyancers, we're not accountants nor financial planners. We might have backgrounds spanning some of those industries, but we don't do that. We have great industry leaders across those different areas that can assist you, but if you have your own people that can help you out throughout the purchase process, that's great. We always go down to the point of making sure your property is let. Okay, again, we're not property managers, but we control the property managers and we wield a fairly hefty stick to ensure they come into line for us and deliver the best superior rental yields for you. We get a high degree of joy out of sitting with clients 1 year, 2 years down the track and reviewing their situation to be able to say, all right, what you bought for $350,000 in 2013 is now worth $420,000 in 2015. By giving people that information, they can then make informed decisions as to their next steps. If that means selling the asset to deal with a particular issue financially, they do it. But we give them the upside potential every year in and out to see when they can leave that asset. Which brings me to the point of why sell. The general consensus is we don't sell property, we hold it, because people assume that the market just keeps going up at an average of 8%. It doesn't. We know it doesn't. The property market moves in cycles. We want to be in the property market during upward moving components. There's no point being in the property market during a period of stagnation. When we look at the Sydney property market, particularly the section from, say, 2003 to 2009, we didn't see any movement in the market. So what was the point of holding an asset that was costing us more as interest rates increased, yet was potentially even losing some value? The answer is there was no point in being in that market during that period. And what actually happened was people would miss out on the counter-cyclical markets around the country, which were actually moving up. For us, we use a proactively managed portfolio. We want to be in the market at the right time, at the right place, and exit those markets so we don't get this period of stagnation. The critical component of this stems back to a time frame. It might take 10 years for one market to run its full cycle. So if we're in that cycle for full 10 years, we've missed two other markets that are moving. If you're thinking about how old you are, how many 10-year cycles you've got before retirement, you would probably want to adopt the proactively managed portfolio approach. That was theory. This is practice. This is what we actually achieve for our clients. A lot of our clients got into the Sydney market in that 2000 and rode the wave right through to 2003. There was no reason that we could see that the market would keep continuing on as dramatic a capital gain period as it had shown. And so we advised many to exit the market. Traditionally, people haven't exited the market because they've felt that they're going to pay too much capital gains tax and the cost to reinvest and they're better off just holding. We paid capital gains tax. The difference between selling and buying was $50,000 in this equation. But we reinvested into a market that was moving and moving substantially. We hit the Perth market, which caught us by a degree of surprise as to how much it moved, but we did expect it to move. We got to a point, though, that there was no reason why it too was going to keep going. When you've achieved that much growth in that shorter span of time, we felt it was best to get out. We got out of Perth, and the gap between selling Perth and getting into Darwin was only $100,000. Okay, again, a big transactional cost. However, we picked a good market that went up again to the point where our $250,000 investment in June 2001 was now worth just under $800,000. That's through 3 purchases. Had we employed the buy and hold approach, we were $350,000 poorer. So it absolutely works, and it's the decision we would make every day of the week for our clients.